Biggest loser. The biggest loser in MLM history, financially and famously, is Wall Street titan and hedge fund manager William Bill Ackman. He is allegedly endowed with rare powers to grasp hidden advantages or flaws in large enterprises, unseen by their own management. He holds the record for losing the most money in history in multi-level marketing. In 2002, Bill Ackman displayed the rare insight that earned him a reputation as stock market guru. He invested millions in a short position, earning profit only if the company's fortunes turned down significantly, against the financial firm MBIA, the nation's largest insurer of state and municipal bonds at the time. These bonds were considered extremely safe, and MBIA's insurance of them gained the highest rating for investor safety. Ackman challenged not only the security of the mortgage-backed assets behind the bonds MBIA was insuring, but also the validity of the sacrosanct rating MBIA enjoyed and on which shareholders relied for its equity value. During his 6-year campaign of market research and publicity to support his MBIA stock position, Ackman endured vicious ridicule, threats, government investigations, and possible criminal prosecution for stock manipulation. All the while, MBIA stock only continued to rise, devaluing his investment. The crash of the housing market in 2008, 6 years after Ackman launched his short investment, exposed the fatal weakness in MBIA's business model that Ackman sought to expose. At the beginning of 2007, MBIA stock had traded at about $70 per share. By June 2008, it fell to about $6 and has never recovered. Ackman's thesis was validated, though it required a catastrophic collapse of the entire securities market, transferring as much as $1 billion in profit to Ackman and his investors from all those who had remained long. In 2012, Ackman purchased a dossier of research from a small consulting firm about multi-level marketing company Herbalife, one of the oldest and largest companies of this type, and among about a dozen publicly traded on Wall Street. At the end of 2012, with great fanfare, Ackman presented a 300-slide multimedia show to the investor community, billed as the Herbalife fraud thesis. He announced that his firm, Pershing Capital, had taken a $1 billion short position against Herbalife and was launching an information campaign to compel the Federal Trade Commission, FTC, to close it down as an illegal pyramid scheme. Over the following 5 years, 2013 to 2018, Ackman reportedly spent more than $50 million on further research, lobbying, and PR to support his case, even sending investigators to China to document Herbalife's violations of China's anti-pyramid scheme law, and to Latin America to expose Herbalife's storefront recruiting centers disguised as nutrition clubs. Using his celebrity status and guru reputation, Ackman also waged a publicity campaign, including producing a short documentary film with interviews of victims who had each lost thousands in Herbalife, all to support his fund's massive short position in Herbalife stock. His profit would be achieved, he confidently told a skeptical business media, when government regulators dutifully closed down the business, sending the stock to zero value. It never happened. The Herbalife stock, in fact, rose to new heights. The extensive research and media attention Bill Ackman generated were largely overshadowed by coverage of Wall Street intrigues to engineer a short squeeze in which other large investors acquired Herbalife stock and boosted the stock price, forcing Ackman to cover his position and drive the stock price even higher. In tandem with the long position taken by rival hedge fund manager Carl Icahn and others, Herbalife launched a smear campaign to redirect attention to Ackman personally. Fortune, the Wall Street Journal, and the New York Times depicted Ackman as an arrogant, publicity-seeking opportunist and stock manipulator. His claims of a massive fraud perpetrated by a 30-year-old company were displaced by personality pieces about his growing rivalry with Icahn. His lobbying efforts, minuscule against the entrenched K Street forces of the Direct Selling Association and Herbalife itself, were characterized as unfair influence on government. It took 4 years from Ackman's first presentation, but in 2016, the FTC brought action against Herbalife, the first against a large MLM regarding its business model in 35 years. The FTC complaint cited most of the practices that Ackman had identified as deceptive and illegal. The FTC spent 2 years on its own study of Herbalife and found, just as Ackman and previous lawsuits had documented, that retail selling was largely non-existent, making Herbalife's direct selling identity false. The nutrition clubs Herbalife promoted to low-income Latinos were shown to be financial traps, as a Forbes article reported 4 years earlier. In reality, the clubs were pyramid recruiting centers, as Ackman's researcher Christine Richard had documented back in 2012. The FTC investigation revealed that most of Herbalife's revenue ultimately came from the purchases by the salespeople themselves. These purchases were induced by promises of rewards for recruiting. Ultimately, Herbalife was falsely promising millions of consumers that it would pay them later if they made purchases now, an extreme form of advance fee fraud. The FTC found that virtually no one who enrolled in Herbalife's plan and made the purchases ever received the promised rewards. The FTC concluded that all promises and claims about income opportunity were deceptive. The FTC's formal complaint against Herbalife, announced on July 15, 2016, on which Bill Ackman had based his billion-dollar short, eloquently described the methods of a disguised pyramid scheme. But the FTC did not charge the company with operating a pyramid scheme, which would have closed it down. Instead, the FTC collected a $200 million restitution, minimal against the scale of Herbalife's global operation, and signed a settlement with Herbalife under largely unenforceable terms and applicable only in the U.S. The settlement gave the company months to enact changes from current illegality, and no Herbalife executives were charged personally. The $200 million was refunded to 350,000 victims, a tiny fraction of the actual number harmed. On the day the complaint and settlement were simultaneously announced, it was also revealed that a lead negotiator working for Herbalife, John Leibowitz, was the immediate past chairman of the FTC, appointed by President Barack Obama. Since leaving his public FTC post, Leibowitz had been, quote, advising Herbalife in connection with its $200 million settlement with the FTC relating to allegations that it engaged in unfair and deceptive acts and practices. Herbalife triumphantly announced its settlement agreement with the FTC and named Leibowitz, quote, senior advisor to the Herbalife board responsible for advising on implementation and compliance matters. Ackman claimed a Pyrrhic victory, a moral vindication on the facts. the booby prize on Wall Street. The business media seized on what the FTC did not do, charge Herbalife with running a pyramid scheme. Herbalife stock continued to go up and up. The total losses Ackman and his investors ultimately suffered extended to the hundreds of millions when he finally closed his position in February 2018. As predicted, this boosted Herbalife stock to the highest price point in its history. Ackman's image as diviner of markets and his reputation for steadfastness blackened. He promised to pursue Herbalife, quote, to the ends of the earth, and never back down. Instead, he folded and fell silent. American Pie. To the small number of people who understood the truth about MLM and Herbalife, the complete failure and rout of William Ackman's campaign was seen as a moral, civic, and criminal travesty. Yet historically, the outcome was entirely consistent with all previous attempts in America to expose the realities about MLM. In his 1906 masterpiece, Sin and Society, to explain the apparent immunity of white-collar criminality that was exploding in America, Edward A. Ross, founder of the American Sociological Association, turned to a Norse myth. In a land of giants, he wrote, Thor was challenged to lift a certain gray cat. Applying his mighty strength, the hero could only raise one paw off the base and was ashamed and confused at his failure. He was later told the feat was virtually impossible, since the cat girds and keeps up the created world. Applying the myth to the prevailing conditions of his day, in which perpetrators of social crimes, adulterating food, chartering self-dealing banks, exploiting children in factories, escaped punishment, Ross explained that when law enforcement sought to curb these crimes, they discovered they were contending not with the criminal underworld, but with the respected establishment in local finance and politics. When Bill Ackman sought to expose Herbalife, he learned, as Ross explained 100 years earlier, quote, he had unwittingly laid hold on a pillar of society and was therefore pitting himself against the reigning organization in American finance and politics. What Ackman seemingly did not realize is a key to understanding the deeper truth of multi-level marketing and the rise of the predatory pyramid scheme, Ponzinomics, as a politically protected business model. The absurd claims and deceptive promises of Herbalife and all MLMs are now enshrined in American culture and even political ideology. Ackman believed he could lift Herbalife into the light of true facts, revealing inherent and pervasive fraudulence, while leaving the established order on Main Street, Wall Street, and Capitol Hill undisturbed. This was impossible. Herbalife's structure and practices are identical to hundreds of other MLMs. For the FTC to declare it a pyramid scheme, the entire MLM house of cards would be threatened. Herbalife and all other MLMs are defended by millions in campaign contributions made to Congress members, who also oversee the FTC's annual budget. Ackman's wager, large as a single transaction, was dwarfed by the billions Wall Street stood to lose if the foundation of publicly traded MLMs was eroded. Herbalife, like Amway and other large MLMs, are influential members and officers of the U.S. Chamber of Commerce. Their recruiting schemes are advocated by the U.S. Department of Commerce in nations around the world. To understand how embedded Herbalife's deceptive scheme is in the fabric of the economy, Ackman would have been better served to set aside SEC filings and take up a study of Eric Hoffer's classic treatise on mass movements, True Believers. Hoffer's seminal text helps explain the enormous social forces favoring Herbalife as it absurdly poses as the standard-bearer of the American dream. Hoffer wrote, "A rising mass movement cures the poignantly frustrated not by remedying the difficulties and abuses which made their lives miserable, but by enfolding and absorbing them into a closely knit and exultant corporate whole." Ackman would have been wise to also study the remarkable growth and social impact of the faith-healing, positive-thinking Christian Science religious movement founded by Mary Baker Eddy, which spread across America in the late 1800s and early 1900s. Christian Science, a nonsensical term invented by the founder, similar to the term multi-level marketing, was skeptically chronicled by Mark Twain. His turn-of-the-century book on the subject acknowledged the movement's almost irresistible appeal and its alignment with financial and social currents of the day, and speculated whether it might become America's dominant religion. Even as the American frontier was closing and massive trusts were consuming entire industries, the Christian Science movement assured followers they still held ultimate power over their personal fortunes and physical health by reforming and aligning their thoughts as prescribed by Mrs. Eddy. Mark Twain captured Christian Science's redemptive appeal, which could later be applied to MLM's utopian promises. Quote, "She has delivered to them a religion which has revolutionized their lives, banished the glooms that shadowed them, and filled them and flooded them with sunshine and gladness and peace. A religion whose heaven is not put off to another time, with a break and a gulf between, but begins here and now and melts into eternity as fancies of the waking day melt into the dreams of sleep." From the Puritans to Mary Baker Eddy's successors and apostates alike, all would successively claim a mystical cord connecting the angels of financial success with unflinching belief in their positive thinking dogmas. It was only MLM, however, that made a global business out of selling feathers from the angel's wings. Others promised great wealth or perfect health from believing and paying the teacher. MLM made a business of selling the teaching rights. The MLM phenomenon may be recent, beginning about 1950, when other distinctly American institutions exploded in popularity, such as franchising, fast food, Las Vegas, and Disneyland, but its roots are as old as America itself. We invented MLM as we invented consumerism, Mormonism, Christian Science, and prosperity gospel preached by Oral Roberts, Pat Robertson, Jimmy Baker, and Joel Osteen. Wrapped in American beliefs and dogma, the fraudulence of a financial pyramid scheme is barely noticed. How and why William Ackman's truth-telling campaign against Herbalife was doomed will be made very clear in the coming chapters. The unraveling of MLM deception, diversion, and corruption begins, as it must, with the very first deception about how MLM all got started.